occur that might knock me into a bad position if I didn't have that $2 leeway in there. So I'm using $2 as my little leeway type of an action here. In this case, the predicted low on May the 4th was 85.13. And so that means that because of the range that we have had recently, that range were a little bit narrower. I might not have $2. I might use $1, but in this case, I'm using $2. And so I'm going to have a situation where I'm going to be selling at 83.13. So at 83.13, I'm going to keep my stop at that predicted high, that 85.13, because that's what I do not want to go beyond that in terms of my loss. And so if I do go beyond that, I'll take my $1,000 loss and try again. And that's what traders sometimes have to do. You may not be successful on your first attempt, but you kind of have to use that as a situation where you get a little experience when that market goes down. In this case, of course, we have a situation where the oil market dropped rather quickly, and so it's not really a factor. Now here's where you come into your plan. If you're a swing trader, you may want to set up a situation where you will take profits. And if you take profits, where are you going to take profits? You kind of have to determine. If you wanted to take profits, let's say, in this situation right here, you might say, well, okay, I'll take profits if I get $5 a barrel. So you might say, okay, at 78.13, I'll take some profits. If you trade a full-size contract, that would be it. If you only had the one contract, that's why I like the mini contracts, because I can say, okay, what I'll do is I'll take profits on one contract, and I'll just keep that other contract in play. And then so what will be my next target? Could it be, let's say if I wanted to put it at 73.13, and I'm not sure that I have the exact spot here, but let's say if it's 73.13, $10 a barrel. Now I'm getting down into the situation right here where I'm getting close to $70, kind of a psychological point. Secondly, it also is fairly close to those lows that we talked about earlier. As you approach those, you got to think that the market's going to respect them. So, are you going to take your profits at $70? That's a profit-taking strategy that you need to kind of line up ahead of the time of initiating the trade. Part of the trade, not only to enter, but it also should consider the exit factor. You may not want to take the profits. You may want to let the profits run, and you may just want to use these predicted highs by keeping a stop above the predicted high, that orange line there, because if the market keeps going down, you're totally satisfied to let it go down. You're still in profits, and you have no great concern. So you may want to just let that take you out of the market. In this case, we're talking about a situation where the market did drop, and we had a situation in May. Here we're about, I believe this is the May 26th date, where we had a predicted high on that candle of 69.39. So in that case, we again are using $2 a barrel. You may have a different idea of how you want to do that, but at $2 a barrel. So somewhere in the vicinity of, let's say, 71.39, you're going to get out of that market, maybe one contract, maybe two contracts. Again, you don't know whether this downtrend is for real, but keeping in mind that overall, we're just starting to get to this idea that we might be shifting from a primary uptrend to a primary downtrend. So now we have, after we move from this point up here where we were short in there, and then we got out right in this vicinity right in here, that $12 a barrel profit, full-size contract, that's $12,000, a mini contract, $6,000. So not too bad a trade if you look at it from the perspective of either way, taking a profit as they are offered or setting a stop above that predicted high and letting that take you out of the market. We'll assume that in this case, again, you are a swing trader, and when you're looking at the whole picture here, you'll see that we have a situation where the market starts to change. We had the Euro index getting into 1, and we had the predicted differences lines are moving up. We start to have a situation where the predicted moving average, the blue line that you see there, starts to move up, and it does make a crossover right in this particular point here where this candle brings it up. Excuse me. where the market starts to do this little shift back into the uptrend. So now you need to determine exactly where you're going to put that stop. And if we use this same predicted high that we had here when we were talking about this predicted high, remember we said that was at 69.39, and so you would be a buyer and go long at 69.39 plus 2, or in the vicinity of 71.32, somewhere right in there is where you would now have a long position. You may have to, depending on how far this market dips, you want to keep your stop down in here. You get very close to it, as the market kind of moves a little bit sideways and then waffles back and forth. If you have a profit-taking plan, you don't have, that based on what we said before about $5 a barrel being your target. That hasn't been set up, so you're kind of in a little bit of a sideways range. If you were to do that, and if you were to keep your stop at the previous predicted high as your stop out point, when the market does drop down and it kind of dips back here, makes this little dive right in here, threatens it, but almost hits it, but not quite. So you would still be long based upon the action that you had. But again, keeping in mind that you maybe have to adjust your plan for a more of a downtrend mode now. So that little dip, you potentially could have gotten stopped out, or you may still barely be long. Now, when you're in this uptrend, assuming that you got in that uptrend, you have the same type of situation. Remember, we're getting into this uptrend here at 71.39, somewhere right in here, and we have to make a decision. Are we going to set up a trade plan to get profit at 76.39, which would be somewhere in the vicinity right in here? Are we going to hang in there? Is that going to be our profit target? That's something that you will have to determine. You can see that when we get clear over here, it takes a little while, takes a little time to get there, but on, then we have a situation here where we might have been able to pick up a profitable trade out of the 76.39 had we stayed into it, into this vicinity right about in here, if that's the way you were doing it. Or when you're looking at it from the other standpoint, you're going to let the market rally up, and then you're going to keep a stop below the predicted low. June 28th, we have a price right here where we have the predicted low, where the predicted low was 77.03 minus our $2 barrel leeway, and so that we would be selling at 75.03. And either to get out of a trade, as we said before, or that could be a potential spot for launching a new trade to the short side, because we're a swing trader and we are assuming the market's going to go make a dip, and we're going to try to make a little bit of money on that particular dip. This was kind of a minor dip. Again, we keep our stop above those predicted highs, or the predicted low rather in this case. We want that market to go down, but we don't want it to get us into trouble by exceeding our predicted low, our stop point right in here. And so that's what we would use as our stop until such time as